Good morning, and thank you for joining the webinar on Electronification for Financial Markets Kenya Outlook, hosted by the Nairobi Securities Exchange and Refinitiv. My name is Richard Pemberton. I work at Refinitiv as Global Director for Central Banks. I'm going to start off with a little bit of housekeeping. There is a box at the bottom. Can you please submit any questions that you'd like to be raised throughout the webinar, and we'll address those at the end. As you can see, there is a toolbar that gives you access to support materials, biographies, and if you have any technical supports, people will help you on hand. The discussion points that we'll be covering today will open with a welcome note from Terence Adambesa from the Nairobi Securities Exchange. Then we'll move on to some panel discussions around the impact of COVID, the impact of electronification in the market, onshore versus offshore investment, and how new products could come to market and which ones will be most beneficial. There will be some polls, so we actively hope that you will participate and give your thoughts on those, and look forward to the outcome. I'm going to present our speakers now. First up will be Terence Adambesa. He's a Chief Business Officer from Nairobi Securities Exchange. There is Stephen Legat, the Head of Treasury Management at SBM Bank. Mrs. Margaret Muthoni, Head of Money Markets and Head of Money Markets and Fixed Income at I&M Bank. Mr. Garacha Enanga, Head of Trading at Standard Bank, and Einstein Kihanda, Chief Executive Officer at ICEA Line Asset Management. So for the first piece, I'm going to open up to Terence to present his view of the market at the moment.
Thank you very much, Richard, and good morning, everyone. And welcome to this webinar. One of the key pillars of the current strategic plan for the exchange is on partnerships, and so we are extremely delighted on our relationship with Refinitiv that has yielded quite a number of activities for the benefit of not only the exchange but the market. The distribution of our market data for both the spot and derivatives market, and recently the introduction of the Fiko call-out system to enhance the trading on bonds on the exchange. I just want to, for those viewers who are not joining us from Kenya, give you a brief introduction of the exchange. The Nairobi Securities Exchange is the largest exchange in Eastern Central Africa, offering products in spot market and derivatives market on equities, bonds, exchange-traded funds, ETFs, and derivatives. We have a strong brand and quite a number of global affiliations, the key for us being the World Federation of Exchanges, the Association of Securities Exchanges in Africa, the Association of Futures Markets, and the UN Sustainable Stock Exchange Initiative. NSE is a self-listed demutualized entity with an excess of 20,000 shareholders, and you can see there a substantial holding by institutional players, not only in East Africa, but foreign as well. I'll walk through the market dynamics during the COVID pandemic. Of course, the pandemic period, 2020-2021, has driven unprecedented participation in the global financial markets. We've seen heavily traded volumes and extreme pricing volatility, which has now become the norm. Market capitalization in Nairobi is currently at about 2.6 trillion Kenya shillings, representing about 25% of the GDP. Of course, this is much lower against the Africa average of about 56%. And so we have quite a bit of work towards enhancing our market capitalization. The index, the main index has declined in the period financial year 2020 by about 29%, of course reflecting the impact of the pandemic on the top 20 listed companies. In terms of market participation, just to discuss, give you a brief highlight on the equities environment. The year to date has witnessed some slightly reduced volatility as improving investor sentiment is witnessed. We hope that this is going to be the trend for the remainder of the year. Foreign investors remained dominant during the COVID period. Average in foreign investors have accounted for about 60% average market participation over the last 18 or so months. In terms of bond markets, of course, the pandemic led to a flight to safe assets or assets that are considered safe, and the bond market was a notable beneficiary of this. You can see a spike there, leading to an increase in bond market activity in Kenya. On average, the bond market activity has been in excess of 140% of the prior year for financial years 2020 and 2021. Currently, cumulative market turnover is at about 566 billion Kenya shillings, which is about 159% above prior same period last year. If you compare this to the previous year, it would possibly be in excess of 200%. So what has been happening around the move towards electrification of our markets? Just a brief background. The exchange started the automation process for the bond market in the year 2004, starting with the automation of the central depository and leading up to 2009, where the automation of bond moved from the previous vendor MIT to Avento.
Oh, sorry, I've been muted as well. Apologies for that. Whilst Terence resolves his technical issue, well, maybe we can just have a quick look at the previous chart. I think Terence mentioned that there's been a large amount of investment into the development side in the exchange over the last 5 years, but that also goes back to 2014. But it's definitely accelerated. I think some of those charts show the increase in activity. Obviously with electronification, we're talking about the advantages, and transparency is one of the key pieces, particularly when we're dealing with OTC markets, dealing across multiple brokers, regional liquidity, global liquidity. It's difficult to find out the best price. So electronifying the market brings all of those bids and offers into one centralized place. But at the same time, that brings price discovery into a cleaner era. Sometimes that takes a little time for that practice to become embedded, but obviously you can see that the benefits in improved prices, centralizing and bringing liquidity together reduces cost to trading. I think what we'll do is probably move on to the next questions for the panels. And if you have any questions, then maybe Terence can address them at the end with the question and Q&A. So the first question that we're gonna bring up is quite poignant, and I think as Terence was showing in the slides, COVID has had a large impact into the way that people are addressing things. So first question is to the panel: how do you feel COVID impacted the debt market over the last 6 months around hard versus local currency? And Gachara, can you open us up, please?
Yes, thank you, Richard. I think, unlike most people have expected in the middle of a pandemic, COVID has been quite a boom for a lot of frontier markets, especially in the bond space. The reason for that is that a lot of central banks got the opportunity to either lower their rates or keep their rates on hold and inject a lot of liquidity into the markets. That liquidity was also met by a very shrinking debt market, and that has resulted in a lot of that liquidity being channeled into fixed income securities. If you remember, in 2013, we had the taper tantrum that ended up taking up a lot of liquidity from the markets. And why not for COVID? I think we'd be in the middle of a rate hiking cycle for the Fed. I think their dot plots had projected that we'd be seeing an increase that have seen tapering start at the beginning of this year, and would be looking towards the first or the second rate hike at the moment, and that will have been. That will have seen a lot of money flow away from developed markets, and this has not only been on the local currency side. I think over the past 6 months, we've seen a lot of Eurobonds being issued, even by some of the countries that have never ventured into it. We're just seeing Rwanda just had one a 10-year this week, and it came out about 5.3%, which is only about 4% above where the UST, the 10-year US note is. So we are seeing a lot of money chasing yield, of course, chasing good names, and this will not have been possible. Why not for COVID? I think would have been in a more risk off tone, and we'd have seen yields significantly go higher. We've seen significant uptick in issues at the moment over the past couple of months. So it's not, when you look at it from that perspective, it's not been all bad whenever it comes to raising funds for governments.
Fantastic, thank you. Stephen.
Good morning, everyone, and welcome to this webinar. I just want to add a few more points focusing on the local market, which Kashara may not have touched. One is that in the local market, we've seen a situation where the offshore participation has really reduced following the uncertainty that has been brought by the COVID situation. I guess that is an element of a risk of environment, as Akashara mentioned, where people are chasing less risky assets in more developed markets. So this has really played out. However, as Ademdesa has just mentioned, we've seen an increased volumes in the primary market in the NSE. And that has been occasioned by the fact that there's been an increased issuance of bonds by government following the reduction in reduced tax collections in the year 2020. And I think this is likely to continue into this year because of the COVID situation, reducing the performance in the economy. Reduced external financing also in the year 2020 because of the COVID situation contributed to the increased issuance. And this increased issuance actually destabilized a bit the yield curve because every new issuance led to increased chasing of yields by the local participants. And that actually affected the yield curve, certainly. But with the increased liquidity that was seen in the interbank market as well as the local market, due to the, I guess many people left cash liquid, became a bit liquid because of the reduced projections on the investments or wealth, as well as the economic activity. That led to a bit of a reduction in the yield curve across the market. That again is in contradiction to the earlier point that there was a risk of environment. You would expect during a risk of environment, the yields would rise. But in this situation, I guess the yields were more driven down by the increased liquidity that we have seen in the market over the time. I just want to add one more point on the outlook of 2021. I think globally we've seen a situation where the global outlook, especially on the economic activity, has looked very positive. And this has led to a bit of talk across the major global central banks of inflation and growth expectations being revised higher. And this actually has led to bond yields starting to rise. Because we've seen in the situation of 2020 when the COVID was more pronounced, the yields fell sharply across the entire world, especially the US Treasury yields, which actually fell quite to the point of below 1. So that in itself has been going into this 2021 second half. We would likely see the bond yields starting to rise across, on the point that the inflation expectations are likely to rise across. And the rollout of vaccine and subsequent reopening of economies is likely to also help in that. Those are my additional points. Thank you.
Thank you very much, Stephen. I think we'll end up talking a bit about future decisions from the Fed a bit later. Obviously, with the change of their policy may change the money flow around the world as people chase for yield. So thank you very much. Margaret, what do you think? What are your thoughts? Sorry, Margaret, we can't hear you.
Thank you, Richard. Good morning. Even on the local front, just to add on what my colleagues have said, on the local front, as with the boom that we have seen in the credit markets, we have seen a bit of illiquidity in the long end of the curve, obviously because of uncertainties. So a lot of the activity has been concentrated on the shorter end of the curve, though with very slight moves. Again, that can show you that there's a bit of uncertainty on that end. So on the local front, a lot of infrastructure bonds trading and a lot of short-end papers that we've seen going through. And a lot of this money also is chasing yield on primary, as my colleagues have said. Off-the-run papers have also seen a bit of illiquidity. No one is really keen on going on off-the-run papers. Guys have been waiting for primary market to just feed in liquidity into that. Of course, in terms of just to be cautious, I mean, you can see the behavior is a bit of caution. On the international front, on our Eurobond issuances, we've seen widening of spreads. Even as we see flow liquidity in there, there's been a bit of widening of spreads, and it can show you that probably there's also uncertainty in that front. As Gashara mentioned, we've seen flows from emerging markets, and this could be attributable to the special drawing rights facility from the IMF that they're about to release, I think, signed off, and some have already, of course, the COVID stimulus packages that have been released. You've seen this money flow into EM credits and frontier markets. So these junk status bonds are, because of the high yields, they are getting a lot of flows in that sense. So we are seeing, even with the low interest rates in the US and the resurgence of COVID, we are still not seeing we are seeing risk on, there's appetite for higher yielding bonds in this market. So we anticipate going forward, probably as we continue with these stimulus packages and IMF money starts rolling into emerging markets, then we will see still a lot of liquidity in that sense in the international markets. On the local front, we anticipate that, of course, fiscal direction and monetary policy should give us direction on interest rates. But again, we anticipate that a lot of liquidity that is coming through should filter into securities, not so much into equities, but securities. Thank you.
Thank you very much. I think your comment on around quality was definitely shown in one of Terence's charts, where the amount of money going into all stocks versus the top 20, people are definitely being a little bit closer and choosier about where they're putting their cash. Einstein.
Thank you. I just want to highlight maybe two small points that my colleagues have not maybe mentioned or alluded to. Number one, on the issuance program, I think what we've seen over the last several months is, especially on the primary market, focus by government or central bank on lengthening the maturity profile of the debt issuance. And so we are seeing more and more long-term bonds coming into the market. And what it has also done is therefore try and manage the debt portfolio of government through the lengthening of the maturity profile. I think the other point I can mention is that that is linked to previous developments in our market. We've seen a gradual recovery in the corporate bond market in terms of issuance. As you're probably aware, over the last probably 5 years ago, we had some corporate bond failures in the market from banks that had, collapsed, and we saw a drought or a slackening in terms of corporate bond issuances. But I think over the last year, we have seen, I think Centum Real Estate issued a corporate bond. We've also seen Family Bank also issue a corporate bond. So I think in addition to all the comments that my colleagues have mentioned, I think is an indication of a recovery, a gradual recovery in the corporate bond issuance. And therefore, from where I sit as an asset manager, what it means is that there's a lot more investable opportunities for pension funds which are long-term, which have a long-term investment outlook. So from that perspective, I see that as a positive development.
Yeah, thank you. Do you think the chase further down the curve is looking at good quality, but to be able to get that yield, you want the credit standingness, but happy to take on a bit more risk by going further down? Is that what people are thinking?
Well, I think in terms of the yes, in a way they are, but I think looking at the historical developments that we have seen in our corporate bond market, there's still some level of caution because even as we look down, there's still the fact that we have that history, and therefore there's some element of caution as we go about that.
Cool. Thank you very much.
Yeah.
Cool. Right. Audience participation time. This is our first poll, and it's to get a little bit of sentiment out there of how do you think foreign investors are shaping the Kenyan market? Do you think they are key for growth and are a positive element? You think they're not required and local partners, whether that's Kenya or around the region, are adequate? Or do you think they're negative? Do they cause problems to the market by maybe being a little too fair where there's parts of them, or others are, it's better to keep it more local funding and more traditional names? Okay, I'll give everybody 10 seconds to submit their thoughts on this one, and then I'll quickly flick over. Okay, that's pretty unanimous. So let's go back to that. Hold on, let's just see if that is the final result. Okay, let's say that is unanimous, and probably the right answer as well. Gashara, what do you make out of that? That there's no comments around anything else?
No, I largely agree. I think if you look at the market and see where we've come from a liquidity perspective, and even ponder and try and see what the most liquid issues are, in as much as foreign investors don't play a huge part, so to say, in terms of an overall debt standing. If you look at it, they're only about 5%, but that 5% of holdings is concentrated in a few bonds, which are the IFBs, which are the infrastructure bonds, and these have become the most liquid part of the curve. We've seen spreads on that reduced to about 5 basis points, which means that you can easily trade in and out of them, and you'll always get a price because you have different interests looking at the prices in those securities. So it's been largely very positive for the markets, and even if you look at it from a hard currency perspective, we didn't have cap points for in terms of borrowing and lending, even to the credit markets that we could compare with in hard currency. But now we have about 4 or 5 euro bonds that were issued by the Kenya government that you can use as a basis or as a benchmark for pricing whenever you want short prices. So I think that has been very instrumental in deepening our markets and in enabling us to build on that. And so we do hope to continue to see more participation from them in the future.
Great, thank you very much. Stephen, what do you think? Anything hidden that
thank you.
might not be willing to admit because they might get... Sorry.
Thank you, Richard. I think I largely also agree with the response for that has been a positive move from the offshores, contributed to the growth of the growth and funding. I just want to add one more for our 2 points. I think participation by offshores really has assisted in the local market to increase the liquidity that we've seen. As Gashara mentioned, they chase a little bit of IFPs and as well as the short-dated paper, which are yielding higher than what they could see in the developed markets. I think the offshores have also demanded quite a lot of improvements and developments in the local market. For instance, product diversification. The NSE has introduced derivatives and futures markets, which largely have an interest in the offshore markets. There is also increased requirement of price transparency and price discovery, which we thank Revenue for the FI call out system that is going to also assist, and hopefully in future we link the offshores to that. Also, the need for improved automation. NSE has been improving their automated trading system, and I believe they also continue to demand improvement of over-the-counter markets that will somehow improve the price discovery as well as liquidity. Thank you, Richard.
Thank you very much. I think you raised a very good point about international investors bringing insight into how to change some regulations or some policies and also products as well. I know the launch of the Bond Connect into the China market, international investors required accountancy standards to change to bring the fundamentals and the data for those bonds to be a much better, higher grade. So, interesting point. Thank you very much. On to our next panel question. And going back to sort of the electronification, whilst we've just spoken about sort of market changes and the impact of COVID, do you think banks are keen to standardize and centralize processes in order to reduce risk? And how do you see technology developing in this space over the next 6 to 12 months? I think maybe 6 months is a little on the short side. Let's think about 12 or 18 months. How are you investing to change your operations? Stephen, will you start us off, please?
Thank you, Richard. Again, I think basically really standardization of processes is one thing that banks cannot ignore, because it feeds clearly to the operational risks that the banks face. In the era of COVID, you realize that many organizations have really moved out of centralized offices by as much as possible working from different locations, including working from home. And in this situation, it actually creates a lot of operational risks. So in terms of banks trying to standardize and centralize their operations, manage this operation risk, I really would want to talk into four focus areas. First is the people. I believe many banks and organizations have really tried as possible to standardize their policies and operation and procedures and rules. They've tried to also centralize their contacts to clients, especially the customer service point of view. And at the same time, the automation of their systems. I believe, for example, the Liquidity system, it is a year that they try to decentralize their trading system, that you can trade from anywhere across the world. The next point I would say is the IT systems. The IT systems are very critical in this standardization and centralization, because this is a point where we've seen a bit of complex systems coming in place in order to try and improve the effectiveness of the operations and as well reduce the operation risk. Many banks, we've seen them going into the centralized cloud system where they can store their data. We've seen a lot of systems that used to be used in bits and pieces have been centralized also, like, for example, the centralization of trading systems through systems like 360T and FXall from Liquidity and all that has also helped in this. Another point you would see is organizational structure. You've seen in the past, you would see a bit of flat organizational structure, but in this era where we're going into uncertain situations, we've seen a bit of centralized management and a bit of business continuity plans and contingency plans that help in this operational risk. Next one is the regulation. Increased regulation has been witnessed in the last few years, basically because of the global situation becoming almost a global village. So we've seen a lot of regulators insisting on following of operational procedures, and at the same time, with organizations operating in multiple jurisdictions, there's a bit of overlapping of an inconsistent regulatory regimes. So this in itself has forced many banks and companies to try and standardize and centralize their processes so that they can meet all this. If you, in terms of how does this develop, how do we see the market in the next 6 months in the technology space? I would put it again in terms of the systems that we have seen. For example, banks in the last 1 year has in the Kenyan market have moved more and more towards online banking and mobile banking. So I would say we have seen a bit of centralization of dealing and payment systems. There's new platforms coming up. The ABI platforms are designed to help customers operate almost like they are in the banking world, in terms of delivering a flexible and a personalized experience to the users. Cybersecurity has been one thing that we can see is affecting the industry, and in the next 6 months, you could see a bit of investment into this by having a bit of anti-hacking tools that would help, because of the fact that many banks and companies are operating away from the office. Cloud computing, as I mentioned earlier, you've seen a lot of data have been stored in the centralized cloud databases and servers. These actually assist to decrease storage costs and at the same time save on capital and operational expenditures that they would have incurred by opening up a lot of data points. The increased automation in the next 6 months is going to be the era we can see. For example, many banks locally are avoiding to increase their branch network, but going into places where they can access their clients through the mobiles as well as online banking and all that. Our FI call-out, for example, is one of the automation that is going to improve the bond trading environment. from phone and email space into a point of easy contact and processing of instructions straight from the dealing process all the way to the settlement at an AC. I think with the increased working from home, we would also see a bit of improvement in the futuristic technologies. In this space, I would talk about blockchain and robotics. That is like you could walk into a branch and you will see a virtual banking hall where you can actually transact almost everything that you need without any existence of an individual or people interaction. This has been seen in developed markets, as well as I see a few local banks have embraced this kind of technology. Another one is I see intelligent customer engagements, which you can see even as we continue that many banks and organizations are interacting with their customers through social media instead of the usual banking or visits. This may evolve into social media banking, where you could actually access your banks through Facebook and Twitter. And this is an interesting environment. I could talk and talk and talk along. Richard, I think I should stop there.
Fantastic. Thank you very much. No, you're right. I think there was probably a lot of mindsets that were fixed, and the arrival of COVID, as a horrible experience as it has been for everybody, did actually spur on a lot of technology development in a lot of firms. I know many banks that would have not entertained any cloud-based or third-party owned databases to store transactional data, conversational data, or client-based data. Yet with COVID, the costs and the time to market, the change of mindset from IT departments to have deployed local hands-on hardware with own information in there changed, and it changed quite quickly. And I think by embracing that, as you mentioned, the wealth market has been able to change as well, with services that are being offered to customers on their phones. So thank you very much. Margaret, what's happening in your space in technology?
Thank you, Richard. Steve has been exhaustive, but I will weigh in and just say that one thing COVID has brought to the fore is the need to cut costs for every bank. So standardization and centralizations are very key to any strategy for any bank in this space. So if we look at automation, especially if I bring it to macro level as a trader, you're looking at price discovery, improving that, operational efficiencies, very little, hands-on manual processing, and that improves efficiency in the operation of the bank. We also see promotes transparency when you're able to trade off systems, and we can see that through if we fully leverage facilities like platforms like Fiko, fixed income callouts. We are looking at trade matching and confirmation. Looking at the Kenyan market, we are a hybrid market where we deal off systems first in terms of emails and phone calls and brokers before we come and confirm onto Fiko, which we hopefully it will change once the rollout is, there's information in the market. So if we leverage on Fiko and we're able to do confirmations or price broadcasts to different banks, then at the end of the day, again, come back to brokers and have it traded, then we are looking at price discovery and deepening our market in the long run. And in the 6 months that we are looking at, like the question asked, we are looking at also having, with the linkage with NSE, we are looking at trade reporting on real time. So if you look at that, then we are developing a yield curve. At the same time, we are improving our operational efficiencies. If we're able to connect, have system integrations with Fiko with our core systems, then you're looking at straight-through processing for all these transactions. We are seeing NSE in line. Then you see trade reporting, yield curve, in the next 6 months, if we are able to leverage on this and fully focus on adopting these automations, then we are looking at a very vibrant market in terms of price discovery. Thank you.
Yeah, I suppose Fiko is still in its early days, and as it becomes more of a established tool and has more transactions going through it, then obviously, as you say, the yield curve off the back of that will become much more useful. You raise a great point that I was thinking. The amount of information when everybody's in an office together that they can share is different when we're all working from home, and the collaboration tools definitely needed to be embraced and brought in very quickly. That's I think investment for front office is always quite strong, but middle office sometimes not necessarily is the place that. So therefore, operational risk was definitely looked at on how. And manual processes that were relatively cheap were definitely needed to be electronified to do straight-through processing, as you mentioned. A simple error is worth too much, so it's good to fix. Thank you very much. Einstein, from an asset manager.
Thanks, Richard. Yeah, thanks. And I think you've already highlighted an issue that comes to mind. I think when you talk about the issue of front office, middle office, and in terms of automation, I think not to regurgitate what has been said by my colleagues, I think COVID has really brought out the importance of ensuring that you're able to invest significantly in automation. What was previously taken for granted and that would be implemented over probably a fairly lengthy period of time, I think prompted asset managers and other businesses to hasten the issue of technology adoption, reliance on digital platforms. And I can give in terms of our experience, for instance, while we had looked at ensuring that we are able to automate our processes over, say, 1-2 year period, there are things that we had to do within a period of about in weeks. One, with the view that if your office is closed down now, what would you do? And how would you service your customers? So I think that has been a wake-up call. And what has happened is that there's now a lot of focus in terms of making it easier for customers to access our services through digital platforms, including making it easier to have digital platforms, for instance, on investment products, right from the process of onboarding of a client, for instance, from the point when they access your services, either through a web portal or a website, right through to the processing of funds that they've remitted, right over to the systems. Now all that is all automated, and this is something that probably would have taken a bit longer to do, but I think circumstances forced us to have to and automate the entire process. So I think we are likely to see a lot more, and I think in terms of remittance of funds, for instance, in Kenya we have the M-Pesa platforms, and we are increasingly seeing this as a reliable means of transforming funds. Clients no longer need to walk into offices to process their payments and investments. So I think on a whole, there's a lot more that we're likely to see, such that everybody can actually access their investment portfolios on their phone from the comfort of their home. And I think it will get even better.
No, yeah. I agree. I think by making that more automated, it reduces the cost. So therefore, certain services can be offered to a broader set of people as well. I think it's definitely accelerated a lot. And this is a worldwide piece, I think, with people sat on sofas while they can't get into offices. It's definitely been something that people are hungry for. Thank you very much. Right, we're going to move on to the next audience participation. So poll time. Sustainability. ESG is spoken a lot about in developed markets. Do you think green financing will pick up in Africa, and particularly in Kenya? Do you think that will be short-term, long-term, or do you think it's not going to be something that's going to be appropriate for a while? Please answer. see the numbers starting to come in. You want to get your view in. Put it through quickly, please. Okay, that's great. Let's see what the results of that look like. So, interesting. Margaret, what do you make of that?
I definitely agree with the answer. There's huge potential for green financing in the public sector and the private sector in Africa. There are a lot of sustainable projects, infrastructure projects. We have energy efficient projects that need financing. But I think what has been holding back, of course, governments are looking to achieve the Sustainable Development Goals by 2030. And then there's need, obviously, to expand on this space. But of course, what has been holding back markets, I think, is more of looking at these issuances as the sophistication around these issuances. But if you look at the benefits of being an issuer or being an investor playing this space, then the benefits far outweigh, the expenses of whatever sophistication that you might be looking at. For an issuer, you're looking at very low borrowing costs because obviously the issuances are at a lower rate. We're also looking at very good ratings, credit worth people. So you are more or less assured of investors coming in and you getting your capital in good time. Then you're looking at investors who obviously will have incentives like tax exemptions from governments when you're getting into this space. And the overall goodwill, obviously, from even foreign investors in terms of cash flows in these types of security issuances. In the Kenyan space, if I might speak to it, we only have a maiden issuances by Aecon Holdings, and it was very well subscribed. And we think that should spur also the corporate bond market that has been on a lethargic, it has been on a downturn in terms of issuances. So we expect that if you look at sustainable financing, these green bonds should be able to spur corporate bond issuances in the market because the benefits are really far-reaching in terms of getting capital in real time. Yeah, that's what I might say. Thank you.
Yeah. It's definitely says that we're nearly 50-50 on yes, definitely versus to some degree. So there's clearly some hesitancy in the audience a little bit. I remember seeing an article from the head of ESG at Goldman Sachs, and he left and then wrote a paper, I think, in the Financial Times, and he said ESG won't stop money chasing after bad companies, non-ESG companies, entities, but it will bring new money to firms that are promoting the right process. So it's quite interesting. It's not necessarily going to be a social change, but it will bring new money that people feel good about in some aspects. Einstein, are you looking into this? Is this something that you have embraced in your part?
Yes, I think maybe just to add, as investors, for instance, in the Aecon issuance, I think that's something that clearly was top of mind. But I just wanted to bring up, looking at the poll results, I think the issue of the developments globally may hasten the realization of the importance of green financing, and I bring this up in the whole aspect of climate change. If you look at what we've seen over the last several weeks in terms of adverse weather conditions, I think increasingly people will realize there's actually a linkage between the adverse weather conditions that we are seeing today and the need to have sustainable policies in terms of all aspects of life. And that will not leave out investment and financing. And so increasingly, while there appears to be hesitancy, as you can see from the poll results, I think this is a matter that's going to gain increasing importance because I think for a long time, the issue of green financing and climate change has been looked at as a very theoretical issue. But what the weather is telling us and the developments that we're seeing right now are telling us is that if we don't do something about it, we will not have a sustainable planet to live on. So there's increased urgency for us to really focus a lot on this green financing. And I think, speaking from a Kenyan perspective, I think there's a lot of growing importance and policy interventions by government in terms of promoting green financing. And I think over time, we are going to see this becoming an increasingly important factor in terms of looking at the investment environment.
Yeah. I think for a long time, people thought that if we embrace this, we're losing out on bigger revenues elsewhere. And I think now the costs of environmental impacts and also there's money to be made in these pieces as they become more widely adopted. So I think that's definitely moving that way. And we've got to do it. We've got to be embracing this stuff. Otherwise, it's not going to be good for us. Okay, we have one final question, and maybe we'll try and keep this quick, just in case we can cover any of the Q&As that have come in through the session so far. Final question is a little bit more about a new product. How do you think the introduction of FI indices will affect market liquidity and foreign investment or sentiment? Would it bring a change in sentiment? Margaret, could you kick us off, please?
Sure. Thanks, Richard. If you look at market FI indices, that already signifies a lot of market depth already. If you are able to churn out indices, then it's market depth. So we are looking at it as a catalyst for flows, foreign flows, a lot of liquidity and price stability in the market. We're also looking at development of probably a more robust yield curve for the market. If you're having liquidity pools flowing in from international markets as well as the local market, then you're able to have a yield curve that is stable, and then you're able to have liquidity in the market. So I think FI indices will be an indicator of market liquidity, and foreign investors are able to track performances and develop their markets as well in terms of coming into our market. Thank you.
Thank you. What do you think about timelines?
Timelines for indices?
When do you think it might be ready? Do you think it's too early now or maybe a bit later?
I mean, it's overdue. If you look at this market, Kenyan market is one of the markets that's a bit, others look at us as very liquid. So if we go by that, then we should be able to have an indices now or later. So probably in the next few months, if we are able to make market players contribute, have automation in our systems, and be able to get good pricing and reporting from the exchange, then we are able to develop a good indices in no time, because we are ripe for that.
Yeah.
Kenyan market is ripe for an indices. Yeah.
Thank you very much. Einstein.
Yeah, just to add to what Margaret has said, yeah, I agree. I completely agree. And again, from an asset management perspective, the issue of also being able to come up with benchmarks that will enable us to assess and clients be able to gauge investment performance of their portfolios, and that's certainly an important element of investment management. So I can only echo and add to what has been said, that there is certainly a lot to gain in terms of depth, in terms of the liquidity of the market by the adoption of these indices. And I agree, it's long overdue in terms of the development of our markets.
Great, thank you.
Thank you.
Kashara.
I think, Richard, allow me to also weigh in just on what we discussed about green bonds and climate investment. And I think the challenge, I'd more or less agree with people who are a bit doubtful because the challenge has been that what ends up being classified as a green investment. If you look at about 10 years ago, we had carbon credits that were meant to be the next big thing. Then those ones ended up dying more or less a natural death. We've seen also that changes in leadership, or especially so in the developed world, changes the worldview. So we at one point coal was considered to be dirty technology, and all of a sudden in the past few years we've seen more or less, especially America, embrace coal again. So I think I see the hesitancy why people may not be fully on board with green financing. But I think the more important bit about green financing is that I think that the companies that do end up adopting green policies end up being better managed and better run, and being more conscious of the environment around them and what affects the world that we live in and how to make it a better place. And by extension, those companies end up being better run and end up being better investments, so to say. So that's why I think the real win is on that space. From an indices perspective, just going from the Kenya perspective, we've seen the equities market, especially two stocks being on the MSCI Frontier Market Index. And what has resulted is that whenever this we see rebalancing in that index, we've seen either outflows or inflows into those specific counters. And that of course ends up for us having to look at it and say, if we see this in the bond markets, are we capable of dealing with the outflows when they come in? I know the inflows are always easier to deal with, but can we deal with the outflows whenever they happen? And then that requires us to be able to look at it more from a governance perspective. Are we running our markets well? Do we have price transparency? Do we have liquidity? Are we looking at managing? I know we've done a very good job of this lately, of managing maturities, but are we placing them in a way? Are we looking into developing and growing the market? So indices end up being more or less a governance. End up requiring a lot of governance around how we run our markets, and of course that is a positive thing. Anything that drives the market forward, anything that brings in more participants, anyone that shines a light on the Kenyan market is always welcome from our end.
Fantastic, thank you. And, Stephen, do you want to close off this question?
Thank you, Richard. I think I'll just echo what my panelists have said in terms of indices helping in market liquidity, transparency, pricing, and improving the investor sentiments. But one item I want to add is that with indices coming in play, then we could see development of associated financial products that go together with indices. For example, in the ETF market, which you could see, we'd see other market-linked products like the more and more development of other derivative products. And I would believe that the diverse products will bring in diverse investor base. What we've been seeing more in our markets is more of vanilla investor kind of products, which actually has not really attracted a lot of foreign investor participation. So if the indices was to come in place, then we could see a bit of diverse investor participation in our markets. And along with that, we could see development of online platforms that could be able to assist in this, and more of market reference data and market maker security firms coming in, brokerage firms improving their pricing. And I think all this will lead in developing the market. At the same time, I think in our market, we've not gone into the securities lending and borrowing schemes, which with FI indices, this can be enabled. Thank you. That's my additions.
Thank you very much. I think we've just hit the hour mark. So let's have a quick look through if there are any Q&A that we can address quickly. I think we'll address some of those separately. So, you want to do question 5?
Yeah, I can deal with Neto's question about the question is, as the local debt market depth improves, do you expect retail customers to shape the market and change banks' trading strategies? I think, especially given our success with M-Pesa, there has been a significant push, not only by the National Treasury, but also by the Central Bank, to try and get retail customers more involved in the market, and it's been very commendable. We've seen also several banks try to reach out and deal directly with the smaller customers with an intention of enabling them to offtake some of the and participate more in the markets. I think there's a lot of scope for this. I think one of the challenges that maybe that the NSE needs to look at is how do we get a different platform for this, because the challenge that a lot of these are not market tradable sizes. The cost of trading them and the process of trading them is also quite cumbersome, and the cost is a bit prohibitive, as we say. But there is a lot of scope for this. So I know that there was an M-Akiba bond some while back, and we did see quite a huge participation in that. So I think that we need to see how to disintermediate this, because in the same way that in as much as they focus on equities and getting them to the end mile user, we need to look at it because there is a huge untapped market. If you look at the more or less in the T-bill space, the significant bulk of purchases that are coming through are not non-competitive bids, which are by retail investors. So they just think, I think we just need to have a pool of how these investors can trade in and out of those securities without having to wait till the term of maturity, because that's what we've ended up relegating them to. So I think there's a lot of space and scope for that.
Brilliant. Thank you very much. I think we've got time for one final question, and the question is, foreign participation in the local currency debt markets of other peer markets like Nigeria, Ghana and South Africa tends to be much higher. Is there anything regulators and other stakeholders can do to increase this? Terence, if you're still there, would love to hear your view.
Thanks, Richard, and thanks, Edward, for the question. I think one of the key issues is around enhancing the awareness of the debt markets for Kenya. Countries like Ghana, even Uganda have done very well in the global space in terms of profiling their debt market. So that's something we need to do better, and definitely, of course, the onboarding process, KYC, AML checks, and the like, towards ensuring easy access to the markets is key. Of course, we would need to then ensure transparency in the markets, ease of trading, availability of trading data, and that should help to lift up participation in our local debt markets. Richard, I seem to have forgotten, to just speak around some of the key issues that some of the participants have talked about. We introduced an NSE FTSE bond index in the year 2011. It has about sub-indices of about 5 of them in different benchmark tenors, and this is something maybe I could just ask members or participants to have a look at. It's available online, to have a look and see if this is something in terms of the discussion around the index products and something that as a benchmark they can use in their line of work.
Yeah, we'll do. We'll definitely send that out to all of the attendees. Cool. I know we've gone over, and everyone's probably ready for lunch. So I want to say, first of all, thank you very much to Terence, and thank you very much to everyone on the panel, and thank you very much to the attendees for joining today. I hope the session has been informative and helpful. If you've got any further questions, please let us know, and we'll answer those offline. So have a great day, everybody. And and look forward to speaking to you soon.
Thank you.
Thank you.
Thank you.